Hey guys, welcome to another webinar presentation with Bay Equity now. It used to be Pacific One Mortgage, guys. I almost said Pacific One, but we're a Bay Equity branch, just to clarify there. And this is the Ultimate Edge presentation webinar series that we have. And today, I'm pleased to tell you we're with Anthony Iacobucci, who has been on previous ones in the past and is with us now. He's a credit repair. And actually, you are the national director. Am I correct on that, Anthony?
Yep. Moving up the ladder here the last couple of years.
Good for you. That's congratulations on that. We haven't talked in
Thank
quite
you.
a while, so good job.
Yeah, yeah.
Yeah. So Anthony and I are going to have a free-flowing conversation today. If you're on the webinar and I see some people are, go ahead and put something in the chat box there and I'll monitor that. Marianne's in the background, we'll monitor that and we'll ask Anthony questions as we go along. And this will also be posted to our YouTube channel, guys. If you're watching this on YouTube, which the majority of people do, feel free to put questions there. We monitor that and we'll get back to you with questions and answers on that as well. So having said that, Anthony, I know today we're going to do kind of a free-flowing thing. When we've chatted some time ago, you told me there's some new stuff, maybe new technology you're using for credit repair, and I'm kind of interested in what you got going there.
Yeah, so we've had a complete facelift, quite frankly, at the end of 2020 into 2021. The tricky thing has been getting it to market. As you know, most of our time resided in offices with our mortgage professionals like yourself, kind of brainstorming, networking, kind of talking about different solutions we can have for some of those credit challenged clients. The new technology we have is fantastic. It is revolutionary in credit restoration. We've just been so eager to get it out to our referral partners so they can get it out to their clientele. So I'm excited to talk about it today.
Cool. Well, tell us about it.
Yeah. So normally, as most credit restoration done in a legal sense has always been really handwritten letter, believe it or not, whether it's typed out or form written, different policies and procedures that must have been followed. But at the beginning of 2021, around April, we launched a digital capability to do so. Our systems are now aligned with both TransUnion and Equifax on launching things digital investigations to the credit bureaus, contesting the accuracy of credit reports, which is great because, as most of us know, and I know the people that are dipped into your channel and your referral partners understand that it's all about everything being 100% complete, verifiable, and accurate in regards to your credit report at a credit bureau level. The Fair Credit Reporting Act allows us to contest those inaccuracies. Those inaccuracies being lifted off a credit profile, that's what puts points back into the consumer credit profile. So it got very clunky. I'm sure everyone understands that the U.S. Postal Service, they were under siege during the pandemic, right? Things were, people were staying at home, people were shipping and using Amazon. So we try to think outside the box a little bit of how can we streamline our process instead of having tens of thousands of letters go out for our clientele nationally. Now we do things digitally. Sometimes it speeds up the resolution on a trade line anywhere within like 7 to 15 business days instead of sometimes 3 to 4 months. So it's fantastic.
Yeah, that sounds really good. So
Yeah.
I'm going to circle back a little bit in the beginning. You alluded to how things get off the credit report with inaccuracies. Can you expand on that, Anthony? What do you guys look for, and what do you do to remove stuff from a credit report?
Sure. So the Fair Credit Reporting Act protects the consumer about derogatory information accumulating or being reported on your credit profile, whether it is a medical bill, a collection account, late payment history, repossession, even up to big ticket things like foreclosures and tax liens and things of that, repossessions, things like that. The inability of creditors to maintain proper documentation that's obligated to follow you month after month of being a borrower, that's where a good credit restoration group like National Credit Care can shine because we expose those inaccuracies. We really expose the integrity of the paper trail that's obligated to follow you month in and month out. To not sound too technical, it's the creditors must cross their T's and dot their I's with all verifiable documentation on any specific account, whether it's an original contract, application, 16-digit account number, bank statements, signatures, you name it, you have the ability to request it to the credit bureaus, TransUnion, Equifax, and Experian. They in turn go back to the creditor and make sure that the creditor has those verifiable documentation. If they do not, they lift it off of your credit profile. And that's the key right there, John. The removal of anything that's adversely affecting your score puts points back into your credit profile and gets you pre-approved with folks that are in need of some help.
Got it. So, Anthony, let me ask you some questions around that. So, question number one, you get something lifted off the credit report. Does it stay off permanently, or do you find that they sneak back on the credit report over time?
Good. That's a really, really good question. So in regards to items being removed off of profiles, it's usually a permanent deletion. Often, oftentimes creditors are using the credit bureaus as a system of checks and balances. They're buying tens and thousands of dollars of portfolio debt,
Mhm.
meaning there could be hundreds of consumers in this bundle of bad debt in which they purchase. The credit bureaus keep that set of checks and balances for them. Once they're removed off at a credit bureau level, especially if it is deemed a violation of Fair Credit Reporting Act, it falls off the credit report completely. It doesn't absolve you of that debt. However, being lifted off the credit profile in the home buying vacuum, that's what's going to put points back into the consumer score and get them lendable for the home loan.
Okay. And then there are certainly different kinds of things that get reported. So there are late payments on active accounts. There are closed accounts that have late payments. There are collections. There's a variety of kinds of things. Given that stuff that you have to work with every day, are certain things easier to get off and certain things are really hard? And to talk about that a little bit, please.
Yeah, good question. It's probably the biggest question I get painted into a corner with. Um, hypothetically speaking, medical debt, especially with the medical collection changes, which we'll get into momentarily, but historically, medical debt has always had a higher success rate, mainly due to the fact that HIPAA's got very stringent guidelines against patient confidentiality, the inability of medical institutions to release proprietary information because it doesn't want to violate HIPAA is always kind of worked indirectly with our investigations to
Okay.
boast really good results. So when I start asking for an original invoice on a medical procedure, if I want to know if there was a doctor present, an anesthesiologist, who is the insurance provider, it's oftentimes very, very, very difficult for creditors to provide that information back to the credit bureaus because oftentimes with medical debt, they're just getting a name, a phone number, and an address. They're simply not getting the verifiable documentation because HIPAA's got very stringent guidelines.
Okay. So medical's easier. What
Yep,
about closed accounts versus active accounts? What's the process and procedure there?
great question. So we're going to attack it in two different ways. So a closed trade line that's been satisfied or charged off with no balance. Again, no debtor is looking for any sort of outstanding balance. What's the monetary gain of a creditor to gather information on a collection account which may have been paid or charged off where they've taken a tax liability? Also, to touch upon that further, late payment history on closed accounts. I think it's a sneaky one that a lot of borrowers don't understand, and even mortgage professionals and agents that we work with nationally. They think that, hey, once an account is closed and satisfied, the late payments that may have accrued on that trade line aren't affecting the credit score. As you know, John, it keeps you stuck in the mud. Um, we have the ability to attack those accounts even when they're closed. Again, higher success rate, right? For example, if I have a paid charge off with 10 late payments from 2019, there's a likelihood I can get those late payments removed because there's no debt trying to be collected upon. Rather
Right.
than if I was late on my Amex credit card back in December and January, well, Amex is going to have a file right at their fingertips with all the verifiable documentation that they're going to need, making it extremely difficult for late payment on current accounts.
Okay, that makes sense. And what about other accounts here too, while we're on this particular side of the topic, which is like mortgages, car payments and stuff? Are those real difficult to get removed? Or are there inaccuracies a lot there? What do you find?
So mortgages are probably the creme de la creme in regards to like how difficult it is to get an account removed. Mortgage lates, an accurate reporting an accurate mortgage reporting, difficult. There's not much movement on there. Repossessions, again, that's something that we can get removed. That's something that we're specialized in doing. I think the interesting kind of paradox that we fall into with a repossession is that a lot of times the consumer, even before sitting down with a mortgage professional, they've gone and returned the vehicle. They said, "Well, hey, I wasn't repossessed. I drove back to the dealership and gave the car keys." Um, there's no difference between an involuntary and voluntary repossession. Just because you didn't wake up one morning and look at your driveway and see the car was gone doesn't mean it's going to code or be different. So, with that being said, repossessions are something that have a fair tendency to fall off a credit profile through our service. Sometimes we're advising to settle on some of these accounts, but again, we don't oftentimes we don't want the client enrolling in a credit restoration program that's partnered with a mortgage professional like yourself and start having them shell out money and start settling accounts, because the date of last activity is so prevalent in the credit scoring model. Oftentimes, it might not be the best thing for the consumer. And I could talk about the date of last activity because I think it's one of the common misnomers out there in credit scoring. A collection is a collection is a collection. A $10,000 collection and a $0 collection, both reporting in February of 2023, will adversely affect the score at the same rate.
Yeah, see, people don't know that. That's amazing,
No,
Anthony.
not at all, right? Because that's where I think a lot of times, before even getting to a mortgage professional like yourself, they start doing their own homework. I'm going to pay my outstanding collections. I'm going to close all these accounts. And that's having an adverse effect on your credit score. Because truthfully, a $10,000 collection reported in February of 2019 and a $1 collection reported in February 2023, that $1 collection is actually hurting your credit score more because it's all about the recency. So I think that's the biggest one, that the little bugaboo that hangs up a lot of clients in regards to, what should be paid, what needs to be done in a credit repair process, what do they need to do to get mortgage ready.
All right. So, what percentage of but when people come to you and say, I need credit repair, can you help me? There's inaccuracies here. What percentage of those people are you able to help? And I used to tell me in the past, Anthony, what kind of score raise increase in the score can people expect from working with you?
Sure. Good question. So what it really looks like is this. On a scale of, like, say 10 people, 3 of the people that we talk to, they're never gonna try to pick up the phone, have a conversation. They're gonna stick their head back in the sand. Another 2 will probably have an easy fix for them.
Okay.
Whether it's paying down a credit card, opening an account, closing an account, debt utilization, fund allocation, balance transfers, little tips and tricks that we understand that we can just send them on their way complimentary and let them execute on their own. And then out of those other 5, we take on about 5 of those clients, and I'd say about 3 of them will get fixed. The other 2, whether it's they shoot themselves in the foot, they become disenchanted with the process. Oftentimes, I think everyone's looking for that quick fix. It doesn't exist in credit repair. We do sometimes get quick deletions, but absolution sometimes is going to take 2, 3, 4, 5 months sometimes. We've cut down on that timeline with our digital capabilities to get automated deletions. I had someone in the state of Florida yesterday. She enrolled at 6 o'clock last night. We did digital investigations. I got back and she had 27 late payments removed by 9 o'clock Mountain Time today. So again, does everyone get those results? No, I don't want to set that bar that high, but there are some folks that are seeing that. So we're really geared towards now efficiency. But I think what everyone needs to understand is, if you've been a bad borrower for 10 years, you do not get a 10-minute fix. So I think that's the big one that we need to understand.
Okay, so credit repair is not fast food, is what you're telling me here, Anthony.
No. Listen, sometimes there are quick fixes, and there's advice we can give, and there's little tweaks, and that's fine. But I think for somebody who is real substantial, they had a blip in their life, whether it was a divorce, inundated with medical debt, a procedure that they didn't see coming, a loss of job, COVID through a curveball. Those people need to buckle in for a 2, 3, 4 month process.
And what is the average amount of time? Is it 2, 3, 4 months for folks? Is that what they expect, or?
Yeah, so we used to be about 6 to 8 months. Now with digital, we've shrunk it substantially. And as your overlay shift, right? Again, we were having conversations during the pandemic where it was becoming a moving target. All of a sudden, a 620 approvable transaction was now a 680, right? So as the overlays have now settled into that 620 mark, seems to be the good baseline. I think we're okay down with that we average nice 15 to 16 points a month. So it's not an overnight fix, but I mean, if someone's got a 500 credit score, you're going to be in the program 6 months. If you've got a 559 credit score, 595, you could be in their program for 30 days just to get 20 points. So again, I think the good thing what we do is that we're very honest on our approach of timelines, but I think the great thing right now that we do offer to tackle back onto the technology is transparency, because we are one of the only non-financial institutions in the United States that have the ability to pull a soft pull tri-merge credit report. It's a master copy report, John. It would mirror a mortgage report that you would pull for one of your borrowers. Now that client gets that upfront, but they're getting new reports as they're progressing through the program. So they're actually seeing the real-time information, the real-time credit score increase, which is great.
That is awesome. Speak to a couple of things here from we lose this topic. What is the minimum time you're going to be in credit repair, first of all, to see any achievable results?
I listen, in the state of Washington, I can only keep, it's a month-to-month program, right? So you're only obligated to me for 30 days. If a bare minimum, if you're like, I just want to sniff it out and try, give me 60 days. That's what I'm saying.
Okay. All right.
You're going to see points. So listen, like I said, that person saw point score movement in 12 hours. But I would say if you want to really just say, hey, I just want to dip my toe in the water. Maybe I'm not trying to get lendable till 2025. I know I've got bad credit. It might not be the best time for credit repair for me, but I know there's some flexibility in the state of Washington where I don't have to be in a long-term contract. Let me dip my toe in the water, see what it looks like. I'd probably say, give me a nice two, 3 solid rounds of investigations. I think that would be fair.
Okay, good. And what does your data show? What is your average increase in credit score for
Great.
folks that come to you?
Yeah. So it's around that 15 to 16 point mark.
Okay.
But I can tell you what other analytics that we have is that at the end of 2019, we got acquired by a private equity group, which brought a level of legitimacy not only to, I think, credit repair in general, but our organization, obviously, right? With that came an influx of information and money to do a technology facelift. And we've found that our clients actually get 137% ROI on the program because we're helping them not only fix their credit to get them a home loan, which is obviously, the light at the end of the tunnel, but they're able to refinance auto loans, get low interest credit cards, get 0% financing, take their, control their DTI ratios. So there's so many other facets of your credit score that come into play that actually the return on investment through credit restoration is 137% on a 6-month trial. So I mean, it's crazy.
Wow.
Right? Yeah.
Yeah. And the impact to your interest rates, guys, in the conventional world in particular, but getting a better credit score is significant. It is worthwhile to increase your scores there if you're going to get a conventional loan. No doubt. So, Anthony, before I leave this derogatory stuff, I do have a couple questions for you. I had a client call because he couldn't make the webinar today and he wanted me to ask you these questions. I'll probably put you in direct contact with him anyway, but he said, ask people because other real estate investors out there may want to know this as well. Sure. He did some construction. A couple of contractors put the contractor liens on him. He's wondering what's the process to get those liens removed and how easy is that or how difficult is that to do?
Yeah. So here's the interesting thing about tax liens and judgments. About 4 years ago, they've been removed off of your credit profile. Anything that doesn't touch the encompass of the credit report, not my expertise. So in regards to tax liens, you gotta get down to the county courts and talk to them and who's got the position, get that stuff rectified. It's not impacting his credit score, which is good. But again, there's a bigger juggernaut that they're gonna have to face with someone trying to get lien position and that kind of stuff. So.
Okay, now these are contractor liens. Are they different than tax liens?
Yes, they are.
This the contract that didn't get paid, or at least they don't like what they got paid. How does that impact credit?
It's not going to affect the credit profile, which is, again, it's not a good and a bad thing. I mean, you remember the days where it used to have public record, John, on the credit profile. It's not there anymore. You have to run a LexisNexis, which is a whole separate report that doesn't affect your credit score. It affects underwriting, but does not affect the credit score. It does not have any implications on your credit score, which I guess is great in the long run. But again, it's still going to be viewed from an underwriter, whether it's, anyone who's looking at it.
Yeah, I'm glad you brought that up here. The difference between underwriting. He had one other thing. Oh, okay. Timeshare that he purchased a long time ago. And now he has a series of 90-day late payments on that timeshare and it's been paid off. Can he deal with that? Can he get it off his credit report?
Yeah, that's something we see a lot of. Unfortunately, it's a lot of our folks down in Florida, in Arizona, and Vegas. It seems to be the mecca of timeshares and timeshares that have gone bad. So yeah, something that we're well versed in. It stinks because it's coded as a foreclosure. As you know, on the lender side, that's a lot more ugly, for lack of a better term, on a lender side, rather than it just being a collection or a charge off or a repossession even. which technically it is a repossession, but it's coded as a foreclosure. And again, I've seen people with a 700 credit score, but a timeshare that went bad 6 years ago, and it kills the transaction. It really does.
Yeah, yeah, it can be a
Um,
problem. But you
yeah.
can be successful in getting those off of there for them. Is that
Yes,
correct?
sir. Yep.
That's
Something we
awesome.
address. Yeah.
That's really, really good. Let's see. I wanted to ask you a question about one thing before we leave derogatory. So major derogatory items, bankruptcies, foreclosures, stuff like that. Are they showing on the credit report still, Anthony?
They are. They are. The bankruptcy stuff can be worked upon. It's just not going to stricken it from public record. Again, I
Okay.
never want to falsify what I'm going to get done for a borrower. For example, John, I'll give you an example. Someone had filed a BK 7, bankruptcy 7, which means they're wiping away the debt. They had 10 accounts that were supposed to be covered in the bankruptcy. They should all be, say, bankruptcy under the trade line and have a $0 balance. Let's just say the 10th one does not say bankruptcy and has a balance. That specific trade line can be worked upon and removed. I think that's the misnomer again with like good credit restoration and people that are kind of scammy. That's the stuff within a bankruptcy that can be addressed. People that are like, I'm going to get a bankruptcy removed. John, even if I had whiteout and took a credit report and whited out the bankruptcy and submitted it to you and your underwriter is going to pull public record and say, why is this on the credit report? Or why is it not on the credit report? And it becomes a big red flag. So it's just important to set the right expectations with the borrowers
Sure.
and set the right expectations with our referral partners as well.
Yeah.
Because again, there's a lot of misinformation out there, and I don't have to tell you. I'm sure a guy as a producer as you are, as a seasoned as you are, you get solicited probably every single day from credit repair companies out the wazoo, wanting to saying they can do this and they've got a magic wand here. And I'm telling you now to set the record straight, it is a timely task that needs to be done, and it is highly, highly regulated, not only in the state of Washington, but in all other 49 states.
That's well put. I should have said this at the beginning, guy. We've been dealing with National Credit Care for well over 10 years, I think,
Yeah.
Anthony, right?
Yeah.
And for a long time. And the reason we stick with them, because you're right, I have a lot of credit repair people give me a call and everything, is because they typically get straight answers to our clients and success. Not everybody gets the same level of success, as Anthony's saying, but we've seen it there. So that's good to know. Um, Anthony, credit scores. Let's talk about that a little bit. What's the difference between credit scoring between the freecreditreport.com model, and they went to the car dealership and got a credit score there, so they got a credit there, and they come to us to get a mortgage pulled, and the credit score is different, and people go, why is it different? What's going on there?
So I'm gonna take it the reverse order. So why there's a difference between mortgage and auto from a credit score perspective. It comes down to the remarketability of an asset, right? If I stop making my auto payment 1 month, 2 month, 3 months, on the fourth month, what happens? I wake up, I go outside to fire at my car because it's a cold winter day. What happens? The car's not there. It's been repossessed. It's going to go to auction. It happens very quickly. If I have a credit card and I'm going on a shopping spree on Bank of America's dime, and I start charging up charge after charge and not making a payment, not making a payment, not making a payment, I go to use that card one day. What happens? It's declined. It's shut off. The consumer that stops paying on their mortgage, foreclosing and getting someone off the premises. I have had clients, I kid you not, that are in homes that are foreclosed and they've been living in that house 6, 7, 8 years sometimes.
That's
And
incredible.
it's incredible that happens. It's about the remarketability asset, right? The bank is in the business of loaning money. They don't want to become landlords and they don't want to repossess homes and try to sell them. So you're a lot more heavily scrutinized on the mortgage side because you've got hundreds of thousands of dollars on the line over 30 years. Whereas on the auto side, tens of thousands of dollars, usually anywhere from 3 to 5 years. And again, they can remarket that asset and put it out on the open market. And then a credit card, they can do something called a charge off, which I'm sure some of our viewers understand what that means, is that they'll take a loss at the end of the year and they'll take it as a tax liability. And they don't really care if they have to shut down your credit card, and they'll just take the tax liability at the end. So that's why between those three, auto, mortgage, and credit card, are the differences. I think the one that kind of is troubling for a loan officer and agent referrals alike is Credit Karma versus what Bay Equity is going to pull.
Yeah.
Credit Karma is in the business of making money. It's a free application with banner ads that are going to try to sell you things, right? They're not going to advertise, hey, come to Credit Karma and find out that you have a 563. They're going to tell you all the warm and fluffy stuff and that your credit score is good. And the reason is the following. There's 4 things that Credit Karma does not calculate that the mortgage side does. First is going to be medical debt. It does not calculate medical debt, which is going to be the first and foremost. It's the #1 collection on a credit profile, that $88 billion of medical debt at a credit bureau level. So Credit Karma doesn't score that. Doesn't score collection accounts under $100 or paid collections. So someone that's gone back and paid all their collections, they're not going to score that. Third is going to be debt utilization under 50%. So if your balance to limit ratios on your credit cards are below 50%, you get a lot of points from Credit Karma. On the mortgage side, you want to be shooting under 10%, just so you guys know. And then last is it does not calculate late payment histories, late payment history that's older than 2 years old. So if I was late on my auto loan in 2018, 2019, 2020, Credit Karma is not going to score that. It's only going to look from 2020 to 2023. So those are the big factors of why Credit Karma is different and has a higher score than the FICO side.
Okay, so I think that what you're saying is the algorithm they use is different than the algorithm we use in the mortgage industry and comes up with a different answer.
Yeah.
Got it. Well, yeah, those things are significant in the mortgage credit report, guys. I will tell you. We look back a long ways. So while we're on credit scores, Anthony, tell us please, what are the major what portions of your credit impact the credit score the most? You used to have that little pie thing that you showed before. That's what I'm really asking about here.
Yeah. So pie chart has been pretty consistent and accurate. Do you want me to share my screen? I can share my screen if you like, or I can just walk you through it, whichever you prefer.
Whatever's easy for you.
Okay, I'll throw it up on the screen here so you guys can see.
Perfect.
So this is a breakdown, and this is actually a breakdown between Vantage score versus FICO. The FICO score has been pretty consistent.
We don't see it yet, Anthony.
Okay.
Do you see a little share arrow at the top right?
Yes, I can share it now. Yeah. All right.
There I see NCC personal credit care. Yep, it's coming.
Gotcha. So this is the slide I want to talk about here. So the Vantage score has been consistent. 35% of the payments of the credit score is payment history. That's where like the collection accounts, the derogatory accounts, late payments, all that stuff hangs out there. But I think the biggest component in which that each and every single person can handle on their own is the 30%, which we call amounts owed. That's just your balance to limit ratios. I think it's important to understand, guys, it's per card. It's not cumulative debt. I'll give an example. If we need to squeeze 10, 12 points out of a file, and someone's got a $10,000 maxed out credit card and a $500 maxed out credit card, those cards weigh the same, even though the balances are substantially different. But it's a great little trick, a little caveat. Pay down that $500 credit card, right? You're not dipping into a down payment to pay down a big credit card balance like $10,000. We can actually get the same amount of points as paying down a small credit card. So a little tip that we give most of our borrowers is start attacking the small credit cards first. You're going to get your most bang for your buck. You're not going to compromise a down payment in which you're going to need for John and his team. So I think that's probably the biggest factor in which I think each and everybody can control. And I know I'll leave you with this in regards to credit scoring, because there's a lot of disciples in the Pacific Northwest of Mr. Dave Ramsey. You need to have open credit cards. You cannot have a credit score. You cannot get mortgage financing if you don't have established trade lines. You don't have to get a big fancy credit card with a huge limit. If you don't like credit cards, get a $200-$300 limit. Hook it up to your gym membership, your Hulu account, Netflix, what have you. You don't even have to take the card out of your wallet and use it. Make sure you're making one purchase each and every month and then paying it down.
Okay. So you hit on a lot of things there. I have some questions on that. It's all really good stuff. back to the balances on credit cards. So if somebody has 4 credit cards and they have different limits on them and consequently different amounts for the ratios kind of thing, does it make sense, as you just said, just to clarify, to pick the smaller 2 or 3 and knock those down to 10% rather than kind of get a same percentage across the board?
Exactly, yes. Because in your example, if 30% of your credit score is credit card debt, but it's per card weighs the same. So 4 divided by 30 is what, like 7.25. So each card weighs 7.25% of your credit score. So just
Aha.
pay down the smaller ones because you don't want to, because listen, first base of a transaction, it's your credit score, right? But then the next thing you want to start looking at, you're talking about, down payments, job history, things like that. So you don't want to compromise your down payment by paying off credit card debt that could sit there and wait till addressing it after you get the home.
Yeah. So if somebody, I'm going to switch gears a little bit here on you. I think somebody wants the optimum credit score there could possibly be. First of all, what's the highest credit score you can get?
850.
850. And so what profile is going to get you over an 800 credit score? What amount of debt and what's the perfect borrower's credit profile for something like that?
I'm not being facetious when I say that you have to be old. Length of history is such a substantial component. It's 15% of your score. The algorithm likes a length of history average over 25 years, meaning that you have to have a 25-year-old mortgage or a credit card open for 25 years, something like that. So honestly, in today's market, I know sometimes vanity gets into the way. I think, and again, you can probably talk about this better than I can, but I think being that 740, 760 range, it's all the same. All the offers from 760 to 850 are exactly the same. You're not
Sure
going
they
to get a
are.
better deal. You're not going to get better finance terms. You're not going to get a better rate. 760 is the number.
Yep, that's exactly right. So what about the trick of the parents who have the card that's got 10, 15 years history and they take their daughter and put her a cosigner, what's the right term for that, on the
Authorized
card?
user.
Authorized
Authorized
user,
user.
thank you. Yep. Is that a good trick to use?
Still works. Just have to be diligent on your understanding your underwriter. For example, if I'm a 21-year-old kid and I pull my credit with, say with Bay Equity, and then I get added onto my mother's account that's been open for 26 years, Bay Equity is going to say, Anthony, you haven't been using this credit card for the last 26 years. You're not even 26 years old. So just be careful of that. Just get a credit card in that 3 to 5 year range that's got good payment history, good balances, no lates on it, and you can add your child onto it. I think it's really great.
Okay, so let's say you can't do that. You're the new couple starting in life here, just got married. You want to purchase a home. You want to optimize that credit score. Credit score is really important, guys, for getting the best rate on different kinds of loans here. So we want to focus on this. So they don't have the ability to put the time into play because mom and dad's not going to do that with them. What can they do to fairly quickly, over a reasonable period of time, get the optimum credit score? And let me embellish a little bit. Is there a certain number of credit cards they should have or shouldn't have? Should they have installment versus revolving? And talk all
Yeah.
around that, please.
Yeah. So I think one thing I like, let's a user example of married couples that have no credit, they're younger. I would suggest, and I've done this time and time again, each of those borrowers get a secured credit card, then add the other one on as an authorized user. So actually you're getting 2 credit cards just by one person opening one. Open Sky's got a great product. They don't check your credit. Capital One doesn't check your credit either for secured credit card. And again, everything weighs the same, right? So that $200 secured credit card weighs the same as a $20,000 limit credit card that I may walk around with that's unsecured. So that's the best way to start. And then about 3 to 4 payments. Get 3 to 4 payments under your belt.
All right. So it takes a little while for that credit
Sure.
card to report to the credit bureau and actually impact the score, 3 or 4
It
months.
does. Yep,
All right.
100%.
And then you mentioned earlier about making payments every month. What happens if you get that credit card and you're not using it for quite a while and it's sitting there with a zero balance? Is that good or bad?
It's not giving you any help. It's dormant, right? Active payment history is month after month after month, not just using it once and then storing it away. So a big thing that I like to do, John, especially with borrowers that aren't used to having credit cards or not comfortable with it, hook it up to something that's subscription based, right? A lot of utility companies, they take it. Like I mentioned, all the streaming accounts, something that you're going to pay each and every month, just hook up your credit card. You can shred the darn thing. But as long as it's making that active payment each and every month, you're making the payment back on it, you're going to get the good points.
All right. And is there an optimum number of accounts to have, Anthony? What kinds of accounts?
More than three. You'd ultimately like to have, 1-to-1-to-1 ratio, meaning installment and credit card. But in a world now, especially someone that you might be dealing with that's like a first-time home buyer, that you don't advise them to go get a car. You know what I mean? But having a couple credit
Matter of fact,
cards
don't go
open.
get the car before
Yeah,
you
in
get the
fact,
loan. Yeah,
don't
want
do
to be
that. Can
clear
throw off
here.
the ratios and inquiries and that kind of stuff. So yeah.
Yeah, exactly. Okay, really good.
Yeah.
What other tips and tricks, that's where we're at right now, for that person who wants the best credit score? What other things have we not talked about that they might be able to do to achieve that?
Great question. I think first and foremost is that knowledge is power. What I mean by that is knowing what's going on with your credit profile is the first step. I think, and John, we've been working together a very, very long time. I've been doing this a substantially long time. Most of our referrals are reactory, meaning that the client's being turned down and then sent to us, and then they're going to go on to a 2-month, 6-month, 9-month program, what have you. I think being on top of your credit on a regular basis, sets you up for success with your potential lender, with the folks at Bay Equity. Having those, it's kind of like those pre-qual questions to the pre-qualification, where it's like, do I have trade lines open? Am I paying them on time? Am I maintaining low credit card balances? Things like that. Am I not taking a lot of inquiries in a specific month? I think those are staying on top of the things that you can control, that control your controllables, right? Like you can't control if you don't have health insurance and you slip on some ice and break your leg. But what you can control is having small credit card balances, paying them on top of on paying them on each and every month, consulting a mortgage professional, getting your ducks in a row to be when you get ready to sit down with John and his team at Bay Equity, you have everything you need instead of playing catch up. I think that's the best advice I can give.
All right. Anthony, can you unshare your screen and bring you back here
Sure.
to the full screen? I want to ask
Sure
you a
can.
couple more questions as we wrap things up here. I'm going to check the chat box.
Sure can. Let me see. And let's see if I can exit out. Oops. It's not liking me to unshare it.
You're just clicking a little thing at the top right still?
Yep. It is not
Well,
liking
I
what I'm
guess it
doing.
likes that little chart. That's not a bad little
Yeah,
chart to
right.
change up
I apologize. Let me.
on. I'm sure it's fine.
Yeah.
Describe for us, please, Anthony, the process that normally happens for people if they wanted to get on credit repair. What do they do?
I am. Oh, I can. So, in regards to getting over to us, I think first and foremost is to talk to you first. I know that you've got your own little tips and tricks on the mortgage side, which there might be some quick fixes that you can identify that gets them on their journey faster. Once you're done talking to that borrower or said borrower, and coming up being like, listen, there's only so much I can do. Let me get you over those preferred professionals. We take the referral directly from you. John, you and your team at Bay Equity, due to our history together, there's preferred pricing for your specific office. So we always like to get the referral directly from the borrower. Excuse me, from the mortgage professional. And the reason being is like the great thing for the consumer is that they're going to have a mini team working for them, right? They're going to have me and you on the backside and an agent, and we're all going to be collaborating on their behalf. They just got to follow the steps in which we set forth for them, and all of a sudden it all comes to fruition, and we're ready for that pre-approval. So oftentimes I want to make sure that that they're coming from you directly.
Yeah, and if I understand correctly, I don't think things have changed, Anthony. The first conversation with you guys is free. Is that correct?
Yes, our consult is always free. Um, we'll go over line item by line item, trade line by trade line. We'll even pull a soft credit report for you. It'll be a master copy credit report, and that's complimentary with our consultation.
Okay, very good. And what is the cost of credit repair typically? Is it vary per person, or how does it work?
Varies per state. State of Washington, I cannot charge a penny more, a penny less than $89 a month. That's approved by the state's attorney general's office. And that's it. Yeah.
Is there a sign-up fee on top of that, or is it started at
There,
$89?
actually, there is. It's usually $179 to get started after consult, but Bay Equity and John, all his clients get a $100 discount. So to start, it's $79. Then every 30 days after, that's when that 89 kicks in. It is month to month. There's no contracts. The state of Washington wanted three things. They wanted affordability, flexibility, and rate discrimination. So rate discrimination meaning I cannot charge more money. I cannot take less money. Flexibility meaning there's no contracts, and affordability. I'm not saying that $89 is a lot or a little, but I think it's a reasonable fee to get back on the path of home ownership.
Yeah, you guys, I cannot overstate how important it is. If you are uncertain about your credit, if you have credit score problems because of past stuff, to take some steps here. There's a soft credit pull available. Anthony just talked about that. That means it doesn't impact your credit score because it's not a hard pull. A conversation with Anthony and his crew over there can clarify a lot. And believe me, getting a higher credit score is significant in the cost of getting a mortgage. We really reward high credit scores over the cost of having a low credit score. So taking some steps and maybe 2 or 3 months with credit repair with Anthony's crew can be one of the best investments you've made when you want to buy a house. So it's quite worthwhile. Anthony, any closing thoughts, anything we have not talked about you think you want to share with our credit repair and optimized credit score audience here?
I think again, just to reiterate, it's staying on top of where your credit score is at, guys. I'll talk about another little blunder with Equifax last year in regards to they were misreporting mortgage scores for 30 days. Mortgage scores. People that shouldn't have been approved got approved. People that should have been approved did not get approved. And this is for mortgage specific credit scores. They screwed up for 30 days. So the point being is keep your eye on your credit. You never know when you're going to need it. You might not be in the midst of the home buying process, but it affects so many other facets of your life. I think it's to be prudent and stay on top of what's going on is vital to that day when you and your spouse may be driving down the street and it's like, oh, there's your dream house. We weren't thinking about home ownership, but that's the one. Or my car breaks down and I need to get a new car. Or, I'm transitioning to another job. I'm going to be out of work for 30 or 60 days. I've got to live off some credit cards. So again, you never know when you need access to financing. So I think just to have all your ducks in a row is very, very important.
Yeah, so agreed. And so you got the process here kind of figured out from what Anthony said. It starts with a conversation, typically with a mortgage professional. My contact information will be on the screen if you're looking at this YouTube. Give me a call. It's not like you have to make a loan application and go through that whole process to explore credit. We can send you over to National Credit Care, Anthony and the boys, and they can help you out over there and get you started and at least find out what your credit looks like and what options you may have with credit repair if that's needed. Quite worthwhile. And the first conversation is free. You might choose not to go on after that, but at least you'll know more than when you started. Anthony Iacobucci, National Credit Care, thanks so much for your time today, man. I haven't seen you for quite a while. You're looking good with that little thing going on.
Thank you, man. It's been too long. I'll let you know when I'm up in the Seattle area again, and we're getting back in the field. So hopefully we'll do this stuff in person next time.
I will do that. Thanks so much for your time today. Thanks, guys.
Bye-bye.